Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to another episode of the Retired Real Estate Investor podcast. I'm your host, Brandon Bruckman. I'm joined by my co-host, Julia Fritzlen, and our guest today, Justin Shore from Hall CPA. It's Hall CPA round two. We had Brandon. We've got Justin, and our mandate for today is to get extremely geeky. Justin, how are you?
Good. Thanks for having me on. I'm ready to geek out on all the tax stuff here. So this is fun.
We enjoy it, and our listeners will too. Let's start here. Justin, why don't you give us a bit of background, how you got to Hall, where you're coming from, and educate our listeners about who you are a little bit.
Yeah, absolutely. So, quick background on me. I started out straight out of college, just doing kind of typical corporate accounting, tax related type jobs and things like that. But I'd always had this huge interest in real estate. Largely for like just the investment premise, but also the tax premise because I was a tax guy. So I was fortunate enough to be able to take an opportunity to manage the accounting department at a real estate investment trust, and we'll talk a little bit more about like those types of investment pathways here in a bit. But while I was there, I learned a lot more about real estate, and I finally had to scratch the itch and started investing myself. So I've been investing in real estate for about 10 years now. And, when I went into public practice, I think what a lot of people do. And I started my own firm and was just doing the generalist thing, trying to service pretty much any clients I could get my hands on. But I was always so interested in real estate since I had been plugged into the market at that point in my career a little bit more with doing my own investments, that I always kind of had that focus or whatnot. And, one thing led to another. Several years later, I had this opportunity to come and join Hall CPA, which our moniker here is the real estate CPA. So like we're a real estate focused firm. And so I've been here for the last 3 years now, and our main focus is working with real estate investors and helping them navigate all the complexities there are around taxation and real estate. And I love it. It's I get to talk taxes and real estate with our clients all day, every day, and that's where I'm at now.
Oh, that's awesome. And what a great. We need more. We need more Hall CPAs, please.
Yeah.
It's a frustrating thing for our clients to not
Mhm.
either find out one of two things. One, they don't really have a CPA and they really need one, and then two, maybe they do have a CPA and they're just not as versed in these special nuanced things that real estate investors desperately need. Are you seeing this too from your seat?
Absolutely. I mean, and like I'd like to say I know where they're coming from because, like I said, I was a generalist, earlier on in my career. But that for me is painted a lot more context to why like it's so important to have somebody that specializes in this, because there's so much in the subtle nuances when it comes to real estate and knowing where all the goofy strategies are hiding in the corners and stuff like that. But yeah, interestingly, we have a lot of our clients come over because they're like, yeah, I have a pretty good relationship with my current CPA and they always get my returns done. And that's not really a problem. It's just that they don't really know much about real estate. And we actually fairly often even get clients referred to us by their CPAs because a lot of times the CPAs like find our content and things like that online. and say, I think these are the people you need to talk to about that side of things. So yeah, it's definitely something we see pretty regularly.
Yeah, I equate it sort of to medical and medicine. So you're not going to go
Hmm.
to your general practitioner when you break your arm, or maybe you do, but should you? You need surgery, don't go to your internist. That's where I look at
Hmm.
CPAs who focus on real estate. Like they're the experts. This is their every single day wheelhouse and tasks.
Yeah, absolutely. That's a perfect analogy. It's I use that often too. It's like you go to your primary care physician when you're having some kind of an issue, but if they go, oh, okay, you need to go and talk to a cardiologist or whatnot because that's their territory. So, yeah, it's a good way to look at it.
Speaking of those nuances, let's
Mhm.
jump into one. So we were talking a bit pre-show about how important it is for our clients and prospective clients as they're reaching that point to retire from active real estate investing, the relationship that they and we need to have with their CPA is critical. And one of the points that we really want to talk about up front is sort of understanding your tax liability, right? Let's answer the question of what happens if I don't perform a 1031 exchange? What does that liability really
Hmm.
look like? I know one of the topics you want to get into is depreciation recapture.
Yeah,
So
absolutely.
please get into that because I think this is missed by a lot of folks.
For sure, for sure. So, the what I tell my clients all the time is that in real estate we like hear these terms like you make your money when you buy. A lot of people are very focused on that front end of just when you acquire properties, but a lot of times so all the exit strategies a lot of times kind of get put on the back burner, so to speak. And but in my opinion, there's way more planning that goes into potentially selling a property than goes into buying a property. Not that there's not any planning to be done when you're buying, but it's definitely more intensive when you're selling properties. And one of the biggest reasons is because it may be obvious, but when you sell a property, ideally, if you've held it long enough, you're going to sell it for some amount of gain. And that, like I said, that seems obvious, but what a lot of people are missing sometimes is that you're also going to have depreciation recapture. So that's the part that often like hides in the shadows. So a good way to think about it is, whenever you sell a property, you'll actually have potentially four different types of income. You'll have the capital gains, which is the best. That's what everybody loves. You get the preferential tax rates on that. But then you get into the different types of depreciation recapture, and there's actually three different kinds, and they can be taxed at different tax rates, which adds to the complexity and the confusion, and why you need to take a little bit more time or like work with a CPA that's familiar with, or a tax advisor that's familiar with this, because there are these different tax rates all being mixed into your sale. A lot of times, taxpayers are really surprised when they actually see like that end result number because they're thinking, okay, I'm just going to be paying 15, 20%, capital gains tax on the sale that I'm going to have. But it can be a lot higher than that in most situations. So, one of the I like to kind of like touch on this too to just like explain to like, okay, for anybody who's not super familiar with like depreciation recapture, like what exactly are we talking about? It's one of those goofy like tax terms, sometimes that it sounds foreign. So throughout the life of your investment, you're taking depreciation deductions. That's that nice additional deduction that the IRS allows you to take. If you're dealing with residential property, you're depreciating over 27 and a half years. If it's commercial or quote unquote non-residential properties, what we say in the tax world, then it's 39-year depreciation. And there's 5, 7, 15-year assets and things like that. We can kind of dig into that here in a minute. But essentially, you're taking those depreciation deductions over the life of the asset. And then when you go to sell the asset, you're going to experience recapture. And I think a less taxy kind of sounding way to like explain that, a lot of investors I talk to refer to this as quote unquote paying it back. So, but what's actually happening on your tax return is that when that depreciation recapture is booked there on your return, it's you're picking it back up as income. So if you think about, okay, over the last 20 years, I took, $300,000 worth of depreciation deductions. Now, when I go to sell, assuming I don't do something like a 1031 exchange, then I'm going to pick that back up as income in the current year, essentially.
how does that, is there a rule of thumb that you're generally using on, like in a vacuum, obviously, if I don't exchange, what's the sort of
Mhm.
effective tax rate that someone could look at? Again, very broad strokes on average.
Yeah, I mean, as a tax advisor, my favorite answer is always it depends, right?
Me too.
But it's going to be in most cases, especially if you've held the asset for like an extended period of time. And when I say extended, I mean, 15 to 25 years, somewhere in that range, like not a super short hold period. You're going to be looking at mostly 25% as far as like the tax rate on the depreciation recapture. And this is so it's again not to confuse with capital gains. You could have say 15% on your capital gains, maybe 20%. But then on your recapture, a lot of it is going to be at 25%. However, like when I say it depends, the caveat on that is it also depends on what your effective, or I'm sorry, what your marginal tax rate actually is. So for folks that are in the higher brackets, like 32, 35, 37%, there is a portion of that recapture that can and will be at whatever that rate is. So you could have some of it as high as 37% as far as what that mixture looks like. Yep.
Yeah, it really does depend.
And
Mhm.
this question came up, gosh, earlier in the year. So whether you have taken depreciation or not, which you definitely should, you're going to be responsible for that recaptured amount, correct?
Exactly. That's actually
So
that's I was
that's
going to
kind of
mention too.
painful, really painful if you didn't take it or know to take it on the front end.
Right. That's it. So the first thing, and we hear this a lot, and surprisingly, painfully, we hear from our like clients that are, new clients to us, they will say that, yeah, my CPA told me not to take depreciation. That way, because I don't want to have to deal with paying depreciation recapture. And the crux there is that you basically have to pay or well, at least recognize the depreciation recapture, whether you took the deductions or not, because the exact wording that they use in the tax code when you're dealing with recapture is it is the amount of depreciation that is was allowed or allowable is the wording that they use. So it doesn't say if you took it or not. It's saying literally if you were allowed to, they're going to assume that you did, which I know it's very frustrating for a lot of taxpayers to hear. They say, well, the IRS has all my returns that I've been filing for the last, 30, 40 years. They know I haven't taken it. Unfortunately, it's one of those situations where they just don't care. Now the silver lining, if you're listening to this and you hear that and you go, oh my gosh, I am one of those people, I didn't know, there is a way potentially to fix that. So and we've I lost count of how many scenarios like this that we've seen over the last few years, but we have been able to correct that. In a nutshell, there's a way to effectively, the way I word it is catch up the depreciation.
Mm,
Now the one caveat there with that scenario is you have to still hold the property. So what unfortunately we have, seen the cases where somebody sold a property in, 2022, for example. And then we're working with them, say now we're recording this in 2020, September 2024, where they find this out, say, can we go back and fix it, at that point in time? And unfortunately, if you've already sold the property, usually there's nothing that you can do about it. So a lot of ifs, ands, or buts there on the scenario. But yeah, if you're hearing that and going, oh my gosh, I need to claim all this depreciation that apparently I'm gonna get taxed on when I sell it either way, that's definitely something to keep an eye out for. But that is one of the more prevalent bad pieces of advice that we see out there fairly often. Not just from, one investor to another, but unfortunately, sometimes tax professionals will make that mistake as well. So
right, because they're just not specialized in this area. Can you talk about like the types of depreciation or the depreciated assets that you can take on residential, commercial, rural, like what sort
sure.
types of, yeah, where does this come from?
Yeah, that's a good point. So the first thing to note is, there are a slew of different asset classifications. There's a revenue procedure that goes all the way back to 1987 that outlines all of the different categories. I forget exactly how many there are, somewhere around 100. But if we're talking about like real estate, in general, with like to what typical investors are looking at, we're always going to have, almost always going to have land, you know, with an asset. Land's not depreciable at all. So the first thing we always have to look at is to carve out, okay, if you buy a property for $500,000, like how much of that is actually in the land?
Mhm.
And we break that out and just say, and it just kind of sits there. When you sell it, it can incur capital gains, but there's no depreciation associated with it. So that one's easy. But then you get into either the residential or non-residential is like the first, if you're kind of like doing like a decision tree, it's like that's like the first chunk that you would look at is, okay, which one of those are we dealing with? And your residential is the 27.5 year depreciation, non-residential being 39-year depreciation. Basically, if you do the math on those, it's when you spread it out over a straight line over that period, the residential is about 3.6% roughly, and then the 39-year is 2.56% roughly. So not a huge difference between the two. But the other thing that you can do is you can break out the components, the interior, like the components of the building, or the property as a whole. And that's typically done with a cost segregation study. Now, the cost segregation study, the whole point of it is to figure out, okay, we know that everything inside of, I'll use like a house, just like a typical residential home as an example. We know that there's stuff inside that house that's going to have a shorter lifespan than, say, like the roof and the foundation and the framing will. So one thing I tell my clients all the time is that it's just like with the whole depreciation's allowed or allowable thing. There's a lot of stuff in the tax code that like doesn't make sense from like a logic standpoint, but it's how they've decided to label everything or the numbers that they classify things with. So I always throw that out at the beginning of this conversation because if we are looking at a residential home and you go in and you're looking for these shorter lived assets, the main categories we see are 5-year and 15-year property. There's also one at 7-year property, but 7-year is literally like the category is if we haven't specifically named this asset somewhere in that list of 100 categories, then it just falls into 7. So it's very, very rare.
Convenient. It's a
7.
catch-all.
It's a catch-all, exactly. So it's usually mostly 5 and 15. Now, 5-year property is going to be like your furniture and fixtures is like the kind of technical term that you would hear. But you can think of stuff like refrigerator, dishwasher, ceiling fans, like for the most part, things that are relatively easily removable. Like you can pull it out of the house and not damage anything is kind of a good rule of thumb. Now, like why I say it doesn't make sense is, okay, that's great. It's 5-year property for like a refrigerator, but I hope in my rentals, my fridges last longer than 5 years, right? So that's an advantageous one where, okay, we have this asset. Its useful life is probably closer to 15 years, but the IRS is going to let us depreciate it over 5. So you just get able to take those depreciation deductions faster. And that's part of the point of the cost segregation studies. You want to find all of those things inside the building that are these 5-year assets so you can take faster depreciation. That means more deductions. That means more tax savings on the cash flow from the rental and things like that. Now your 15-year property is typically going to be considered land improvements. So, and that one is actually, it's pretty self-explanatory, but you can think of things like fencing, sidewalks, driveways, if you do like a stamped concrete patio in the backyard for like an outdoor kitchen, something like that, where it's basically above the dirt, but it's not like attached, physically to the house in some form or fashion. So you can have a lot of stuff outside that's going to be 15-year property. Now, where the goofy part comes into play with all these is there's that's how kind of how we go like down the decision tree is, okay, well now we're in the house is 27.5-year depreciation, but then we start going into where's the 5 and 15-year stuff. The tax code gets even like more complicated when it comes to those types of things, but the 5-year property is referred to as a 1245 asset. That's like the code section that it sits under. Now, the 15-year, like all those land improvements I was talking about, those are considered to be Section 1250 property. And why that matters is when we come back to looking at depreciation recapture, this is where, back to like alluding to what we were alluding at before, is you've got these different like tax rates that are going to be applied. So when you're dealing with 1245 recapture, it's always going to be at your ordinary rate. So that could be your 32, 35, 37%, tax rate. Now, when we get to section 1250, we have to bifurcate that even more. So there's two different types of section 1250 recapture. And again, super illogical names. One is called 1250 recapture, and the other one is unrecaptured 1250 gain. So I hate those terms. They sound very illogical because here we are talking about depreciation recapture. So why would we say unrecaptured, right? But what it really means in English is your unrecaptured 1250, that's going to get a preferential tax rate. And that's the one that gets capped at 25% as far as like a maximum tax rate. As of, today when we record this in 2024,
Right.
who knows in 10 years what it'll be. That's actually been around for quite a while though. So I'm not super concerned about that changing. Now, the other one though is the recaptured 1250 gain. That piece can be taxed at your ordinary tax rate, your 32, 35, 37%. And what's interesting is with that is when we're trying to figure out like how much is actually going to fall into that, because it makes a big difference. If we're saying like, hey, you got some depreciation recapture that's going to be capped at 25%. Well, we don't want to make the mistake, or the taxpayer doesn't want to make the mistake of assuming it's all 25% because a big chunk could be 37%, all the way up to that maximum rate. So we have to dive deeper into what kind of depreciation was actually taken on these tax returns. Now, how in the world does some of those land improvements, say for example, those 1250 assets, how is it that some of it can be 25% maxed out and some of it can be 37? Well, the way that they word this in the tax code is if you take depreciation that is in excess of what straight line depreciation would have been on that asset. So like think of if I got my cost seg done, I've identified there's some 15-year property, in this house because of fencing and, driveways and stuff like that. Now, if I just take it over 15 years, just straight line, roughly 6% per year, then that's going to be that straight line number, and all of that wouldn't be in excess of straight line. It'd be right in line with straight line. So all of that would be capped at that 25% tax rate. So, but we have this option with 15-year property to accelerate those depreciation deductions because, again, as we're recording this right now, in 2024, we have something called bonus depreciation that's still available. And in 2024, you can take 60% bonus depreciation on assets that have a class life of 20 years or less. So that means on the 15-year assets, we could take 60% bonus depreciation. In a practical example, that would be like, okay, if there's $50,000 of 15-year property at this asset, then 60% is $30,000. So I can accelerate $30,000 of depreciation deductions on that. Now, where it gets funky is what if you sell that property after like 10 years? That's where we have to work in that calculation and figure out like, okay, we know that you took $30,000 of bonus depreciation in that example. And then you also took straight line depreciation afterwards too. So it's not just that you get it right there at the upfront, you get the accelerated chunk, and then you still spread the remainder out over 15 years. But we'd have to look at 10 years, what would it have been if you just took straight line? And okay, that would be, in that example, we had $50,000 of 15-year property. It would be, I picked terrible numbers for this, but that would be, at straight line, you'd be 2/3 of the way through that. So that would be what, like roughly $36,000, somewhere in there, if I'm doing the mental math correctly. So we'd have to compare what that number is to what you've actually taken over the lifespan and say, so far, because you accelerated some of the front end, you've already taken 45,000. We would actually have to split that out and say, okay, anything in excess, roughly 10 grand of depreciation recapture is actually going to be at your ordinary rate because that's in excess of straight line. But all the rest of it is going to get that preferential tax rate. So this is it's a complicated thing to examine, but if again, this is why I say like there's so much to consider when you're selling an asset on these exit strategies, because if you were looking at that prospect of, okay, that basically means that if I sell this property after I've owned it for 15 years, then I would have taken the full amount in the 15-year time period anyways. So I actually would be right in line with straight line again at that point. So basically the longer I hold the asset, the more that depreciation recapture will slide its way back into that capped 25% tax rate. But definitely makes the exit strategy like considerations get a little bit more complicated when you have all these different types of depreciation kind of factor in there.
On the exit, so if you're working with the client and you're working, and this is what you described as extremely complex, what you're
Mm-hmm.
working on the depreciation schedule, is it relatively easy for you to pick that up and answer the question of, what tax would I owe if I sell this property and don't exchange? Is that an easy question to answer? And then how often are you looking across their entire sort of tax picture? Are there situations where that you can think of where clients have other losses that are kind of offsetting that and reducing that liability? Help us think about what that sort of looks like too.
Yeah, absolutely. Yeah, I would say, I guess like for me, it's relatively easy to look at that because I've done it so many times. But yeah, as long as they have all their information on the tax return, and we're able to get it, from prior CPAs or something like that. And we've built, tools to help like our team do this quickly and stuff like that too. But so yeah, a lot to consider, but we can get down to a very, very precise figure, there's always things at closing that might change it. Oh, okay, closing costs changed a little bit and stuff like that. But that's kind of getting down to like, pennies and dollars and not in the thousands of dollars range. But yeah, it's not yeah, not too crazy to get like a pretty precise number when you want to figure out, yeah, what that tax hit's going to be at. And that's like a big consideration we're working with our clients, because that leads into, okay, if you know that that's going to be the tax hit, then it kind of, helps you decide, do I want to jump through the hoops to 1031 exchange essentially? We talk all the time about like, is the juice worth the squeeze? Is it worth the hassle or or whatnot? So you definitely want to take that into consideration. But to your point, you have to take into the clients like what I would call like their global, perspective is, yeah, what else is going on in their tax return? What else is happening in the current tax year? Is something like a 1031 exchange even necessary? And I couldn't say like a percentage of the time, but I mean, it's very frequent that we have that conversation with clients and say like, no, you actually probably don't want to do a 1031 exchange right now, because again, mapping all that stuff out, just depending on the situation of what else they have going on in the current tax year. So yeah, it's another like huge it depends. But no, I think, that's a big thing that why we focus on planning so much, is because if you're having those conversations, beforehand, you'll see that there are so many different options that you can look at as far as, okay, it's not just, pathway number one versus number two, like an either or situation. You might have 3 or 4 different ways that you can slice it. And they all will have different tax impacts. So,
Yes,
Yeah,
and I feel like the last 10 minutes you've highlighted exactly why you need a specialist from the
mhm.
get-go and planning out, okay, you purchased the property. How can I best take advantage of my, tax implications during ownership? And then on the back end, how can I look 3 years out ahead of a sale, even 18 months out ahead of a sale? What's the best case scenario for me in my situation? So if you've run the numbers, you've worked with somebody and they've decided, okay, a 1031 exchange is the best outcome that I can have, what's sort of the next workflow for you all?
Hmm. Yeah, exactly. So let's talk about the 1031s a little bit there too, just to kind of talk about what those like some of those exit strategies look like, because like I said, it's we when it comes to depreciation, we don't want to be afraid of it, right? And we know we have to take it. We definitely want to take it because um it's at the end of the day, we're still looking at like time value of money, right? If I can be saving taxes year after year after year, instead of paying it to the government because I'm getting this nice tax benefit, I'm okay with getting hit with some depreciation recapture when I sell, because I've effectively taken out a no interest loan with the government is how I kind of like to look at it. Sure, I might have to pay it back, but what did I do with all those tax savings for the last 10, 20, 30 years? I probably used it to expand my investments in a more tax advantaged way. But the beauty of it is we don't even have to necessarily take that hit because we can use some of these exit strategies around like 1031 exchanges to I don't want to say completely like permanently avoid depreciation recapture, right? Like it's always out there, But the more accurate way to state it is with the 1031 exchange, you're deferring that income recognition. So we use that term a lot. It's a tax deferral, not 100% avoidance there. Unless, and this is, I know it's a little morbid to say, but one of the more popular strategies out there is nicknamed swap till you drop. 1031 being the swap, drop is you die. So the reason why that is a permanent like tax maneuver is because if you pass real estate, like appreciated assets, to your heirs, whenever you pass away, all the depreciation, recapture, and everything, it actually gets wiped away because your heir is going to step up in basis. So they basically get to take on a tax basis of whatever the property is worth. So that one actually is pretty darn huge. But
I prefer the perpetual exchange instead of the swap till you drop. It is morbid.
Yeah, it's catchy, but it's more
strategy is to perpetually exchange.
Right. So with the 1031 exchange, well, why we said like, what I was mentioning before, why we would analyze this with clients to figure out like, is it, worth the hassle, right? Is because it's not super easy. Like there's some planning that still goes into this. And to kind of do like the kind of overview highlight for 1031s, for anyone who's not already familiar with the 1031 exchange, you have 180 days in total to actually complete the exchange. So that's like the main time window. But on the front end, once you sell your property, you have 45 days to identify potential replacement properties. So that's a pretty fast, closing window there. Is just and you have to legally identify the potential replacement properties. And there's several different options for like how to identify your replacement property. The most popular one, because there are 3 different options, but the most popular one is that most people are using is you can identify up to 3 replacement properties. Relatively straightforward. And the reason why you'd want to have 3 is you want to have options, because if you identify one property within that 45-day window, but it takes you longer than 45 days to close but you still have that 180-day window to actually close, then what happens if that property falls through? Maybe you do an inspection on it, something goes wrong, and you're like, oh, we're not going to buy this now. That's why you want to have a second and a third one as kind of plan B, plan C for replacement options. Now, the other 2, and these, like I say, that they're not used anywhere nearly as often, but sometimes are forgotten about by tax advisors, is instead of identifying 3, you can identify as many properties as you want, but the total dollar amount can't exceed 200% of what you're selling. So real simply, selling for $500,000, okay, I can identify up to $1 million worth of property, and maybe it's 10 properties that are worth $1 million. You could do that. The other option is you can, if you want to exceed the 200% mark, is you can identify as many properties as you want, but you have to close on 95% of them, which is, might as well say 100% at that point. The only practical scenario I've ever seen this with was where I had a client that was actually selling a larger commercial property, and it was worth several $1 million, and they were actually wanting to purchase a package of homes from another seller that was selling roughly 20 or so properties all at the same time. So kind of rare for that one to come up. But all that being said, 1031, has that hassle factor, and as not as big of an issue now as it was, say, like 2020, 2021. But when the real estate market was really like on fire there for a while, we had a lot of clients coming to us and saying, I had a 1031 fail. What do I do? Because the property they identified got snatched up by somebody else before they could acquire it. So that's always something out there that could happen. But aside from that, you've got a little bit of cost with 1031 exchanges as well, because you've got to employ a qualified intermediary to assist you with the exchange. And the QI, as we would call it for short, is basically that person who's going to hang on to your funds the entire time. So that's another really, really subtle but key thing that you have to make sure you have lined up before you do 1031 exchanges. You want to have that QI lined up ahead of time, because if you touch the cash, then you've blown the 1031 exchange. We've had numerous of those conversations with clients in the past where they said, yeah, I just put the money in a savings account, figured I'd let it get some interest while I, acquired the next property. I see Brandon raising his hand. Yeah.
We have
So
these
that's
conversations way too often with folks. And I
right.
hate to be the person, you do too, probably, Justin. I hate to be the person to break the bad news. There's nothing that we can do to save that once you hold it.
And it's one of those things where just it doesn't make a whole lot of sense as to why, it's one of those deals IRS says, hey, you have to do it this way. And again, if you're not, working with somebody who's familiar with, real estate and these things, you wouldn't think twice about why do I have to have this separate professional hang on to my money while I, buy this next property. That I thought the main thing was I just had to reinvest the money from the sold property into the next one. So yeah, a lot of subtle issues that can come up with those 1031s. So we often will kind of have like a 1 hour planning session with clients on just how to go step by step. We've kind of glossed over a few of the steps there, but definitely want to work with somebody that understands how each one of those steps in that process is supposed to go for sure.
What's your mechanism from your perspective as a CPA? How are you preparing that? How are you preparing those tax statements at the end of the year once someone's done a 1031 exchange? What are the things that you're looking for to make sure they've properly completed the exchange and are getting full tax?
Mhm. Yeah, that's a good question. So first thing that we want to see is just all the documents from the qualified intermediary, because they should have submitted legal descriptions for the identified properties to the QI, so that can be documented. And then we always want to see like a settlement statement from the property that was sold, because that's going to show that those funds went to the QI. Instead of at the bottom, you usually have that funds due to seller box. We want to see nothing or as close to zero as possible, because it all is funds that went to the QI. And then kind of similarly on that, the acquisition on the replacement property side, we want to see the settlement statement or the HUD statement, pick your parlance there, for to also, because that's where we can see the funds coming back in from the QI as well. And then also that's giving us a crucial information that we need to see that, okay, the replacement property was of sufficient value to be able to substantiate the full 1031 exchange. And sometimes there's not. Sometimes they're, maybe they buy a property that's worth, purchase price is a little bit less than what they sold. And in that situation, it's not a completely blown 1031 exchange, but they might be recognizing a little bit of boot is the I do air quotes on that, is the terminology, but that's basically the portion of the 1031 exchange that could be taxable because you more or less you didn't buy something that was big enough.
In your world, what portion of exchanges are you working with where an individual or an entity is taking a partial exchange? So they say, okay, this property is $1 million, but I really want 200K to take my family to Australia or XYZ, whatever it is.
Yeah,
Seen that? Or is general?
it's it's definitely something that, I mean, we bring up on every single conversation. Hey, is there a chunk of funds that you want to be able to pull out of this? Is that something that you want to go on vacation or to buy the new car, or something to treat yourself in some form or fashion? And it kind of goes back to that, looking at their entire picture too of what else is going on during the year, because there could be some options to pull some of that cash out and it just not be taxable either. And if we can do that, that might be something that we want to do, especially depending on all the other investments that the client's wanting to make that year. Because some for example, maybe it's not even, oh, I want to pull $50,000 out to go on vacation. They might just say, I want to pull $50,000 out because I want to throw some of it in the stock market. I want to earn mutual funds or anything like that, or cash value life insurance policy. All kinds of different things that you could do. Use those
Address this
proceeds
debt
for.
over here that is unreconciled.
Right. I've got credit card debt that's just personal. I just want to use that to pay that down. There's all kinds of things that you might want to pull some of that out for. So, but I would say people that actually go through with that, in our world, it's a little bit more prevalent because we are working with real estate investors that and often have a lot of other options. I would say probably about 20% of the time that it's done on purpose, that they're pulling some of the funds out. Just because they're either offsetting it with other losses that they have, maybe from like another rental property that they had a cost segregation study performed on, things of that nature, something like that, or it's just, yeah, I need to pull some funds out for personal use. So, but another major consideration that you would want to like talk that through of what does it look like if we pull 50,000, 100,000 out of the exchange for sure. So
Conversation we're having almost every time.
Hmm.
about what that looks like. Help me think about, here's a curious one that I think trips people up. And this will kind of dovetail into maybe our conversation about Delaware Statutory Trusts.
Hmm.
But very often, clients come to us that have held assets for a long time, and that depreciation schedule is running out. And
Hmm.
I don't think they're ready for that. And then we get into maybe Delaware Statutory Trust, maybe a different replacement property, and all of a sudden the fund deductions they've been enjoying for many years start to go away. How do you sort of maybe strategize with your clients about thinking about maybe trying to restart that schedule, or maybe what's your approach when we're reaching the end of that and it just becomes less favorable on a yearly basis from a tax perspective, the income that's coming off
Hmm.
the real estate?
Yeah, yeah. So basically, when the depreciation fuel tank starts to run low, after that 27 and a half years or whatnot that you've been depreciating, or 39 years that you've been depreciating it. So I mean, the simplest option, there's one, if you just acquire another property that you can have something that's now you've got some additional depreciation that's going to happen, and maybe you're using something like a cost segregation study to expand on that. And the one of the many beauties we have with the real estate in that regard is that if you have, say, a new property you acquire this year and it generates $100,000 of losses because of the accelerated depreciation, that can be used to offset taxable income from your other properties. So, in a way, you can kind of think about it as like it's sliding over and absorbing some of that income. Now, as we're kind of looking at like something like 1031 exchange, in most cases, with our clients, they're usually performing a 1031 exchange because they're gonna go up in value because their properties if held it for 10 years, it's appreciated a lot. So you have a lot of equity there. So that gives you the opportunity with new leverage on the replacement property that you could be, say, selling for 500,000 and 1031 exchanging into $1 million property because you've got enough equity to do that without having to put more cash into the deal. So one of the major advantages of 1031 exchanges is that you can use that strategy to replenish the depreciation fuel tank a little bit without having to necessarily invest additional capital. And that same mechanism could be at play when you're doing something like 1031 exchanging into something like Delaware Statutory Trust, depending on what the leverage is going to look like on that asset too.
Mm-hmm.
So I'd say most people that we work with that are in that mode where it's okay, I've held this property for 15 years, 20 years, something like that. More often than not, it's got a low debt load, like a really low loan to value. So they've got a lot of equity, and it presents that option. Unless they've done multiple refinances throughout the years, that potentially is going to be something that has to be taken into consideration too.
Yeah, it's something we help people think of is their natural sort of risk inclination is to say, hey, my property's paid off. I want other zero debt replacement properties for that.
Mm-hmm. Mm-hmm.
But then, yeah, we do bring up that tax component to it. And then the gears start turning like, well, wait a second. Maybe I do want some of that leverage. That might actually help a little bit. Start a new depreciation schedule, blend those together. Might reduce liability. One of our largest clients, we were very surprised when we got his first and second year tax returns back from DST Investments. We found out all the taxable income was sheltered.
Yeah.
We
Yeah.
were really we
Absolutely.
were really surprised by that. And it makes it the economics on it obviously make it better than what we had anticipated. It's a really good thing. On
For
that point,
sure.
sort of like dovetailing that question a little bit, Julia is dealing with a lot of land, farm investors, and like we had talked about before, not
Mm-hmm.
all of the value of what they're selling is depreciable. How should they start thinking about transitioning from those assets to maybe Delaware Statutory Trust or other commercial real estate? They're going to get a kick in depreciation, right? With that they didn't have before. Is that a fair way for us to think about it? And Julia, maybe add to that question a little bit what you're actually experiencing.
Yeah, yeah. I mean, if you have a situation where it's okay, we've got farmland, for example, and I've worked with a lot of clients in that space as well, and they just they don't have any depreciation that's being taken there. The way you'd have to think about that is okay, we don't have to deal with any kind of like depreciation recapture, obviously, when selling that property. However, what when you do a 1031 exchange, there is, like we said before, it's a deferral, right? So like you're deferring the gain, and if there is depreciation, you're deferring the depreciation recapture. But tax basis is staying the same. You know, in a real simple like kind of example, we've got this property that originally we acquired it for $200,000, but now we're selling for $500,000. If we successfully do that 1031 exchange, we're going to defer the $300,000 gain. But if there is any depreciation, we're going to defer recognition of that as well. But the basis of the asset is still only $200,000. So, but more specifically to your example is like, okay, if that $200,000 chunk of farmland, maybe the 1031 exchange into a DST occurs, you're still going to be at that 200,000. So it's not like, okay, if we sell for 500 and we make the DST investment at $500,000, that we're going to be able to get like $500,000 worth of depreciation during that time period. It's going to be 200,000. So it is still beneficial because you're getting I don't want to say, I don't want to use the word avoidance. You're getting the deferral on the gains, yeah. So you're not paying taxes on the gain. But you are moving into a depreciable asset. You're going out of a non-depreciable asset into a depreciable asset. So you'd still be, picking up some of that benefit. And then of course, if there's things like debt that's being applied or whatnot, you can get additional basis through the debt as well. So that is one of the advantages to going to, if you're going from no leverage to something that is a little bit leveraged, is you're actually going to get, it's one of the unique pieces of real estate, as long as it's not held through a corporation. We get that nice benefit, as long as the debt is, and again, a little bit tangential here, but it does have to be qualified non-recourse debt is the technical term. But like a DST is always going to use a QNR like source of debt if they're using one. So
we're trying to have our cake, eat it too, throw a side of ice cream in there. maybe too greedy on that one. Sort of a little bit. Transition. So we mentioned Delaware Statutory Trust. Talk a little bit about, from your seat, your viewpoint on Delaware Statutory Trust versus the UPREIT. Maybe describe the UPREIT for our listeners a little bit so they can understand that. And just your viewpoints on it. I mean, you worked at a REIT, so we'd love to hear that viewpoint as well.
Mm-hmm. Yeah. We took dozens, if not a couple hundred, those UPREIT transactions there. So the trick is with 1031 exchanges is that you cannot sell. It's got to be you sell real property and you replace it with real property. So sounds pretty straightforward, but the tricky thing is that if you are trying to get into something like a REIT or just a partnership in general of any kind, because there's typically always a partnership component to REITs. And sorry, I keep using that term. The REIT, again, it stands for Real Estate Investment Trust. But we have so many of these acronyms, they're too much of a mouthful. So you just call them REITs for short. But with the REIT, eventually you're going to wind up with a partnership interest, effectively. And the IRS doesn't consider a partnership interest to be real estate. So when it's all said and done, you have and I say interest in a partnership. Basically, you can kind of think of that as being like shares. They're technically called units in a partnership, but you've got units in this partnership. So some fractional portion of the partnership. Now, even though that partnership, if all it owns is real estate, when you try to do that exchange, the IRS doesn't consider that what you actually own is partnership interest. You don't own real estate anymore. You have a portion of a partnership, and that partnership owns the real estate. So it presents this issue, or I want to say issue, this hurdle of, okay, well, what if we want to sell our real estate and we want to get into that REIT structure because we want to be totally hands off, basically be limited partners and let them handle all of the management and operations and just send us the distribution checks every quarter. Well, you can do that, but we actually have to combine a lesser known code section, and it's the 721 exchange. So effectively what happens is you do your 1031 exchange, and as long as you replace it with real property, so that means we're going to go into a different form of ownership. We're going to go into a TIC structure, a tenancy in common. It's a more basic version of you can kind of think about it as like a partnership, but it's basically saying like, hey, me and these 50 other people, we're all going to acquire this asset, this piece of real estate, but we're all just going to effectively own it directly. There's not going to be a partnership that governs it. And that's referred to as a tenancy in common. And, it can be with 2 people, could be with 50 people, whatever the case may be. But it satisfies the 1031 exchange because you're literally buying, and that you've got 50 partners, or I'm going to own 1/50th of this building. is effectively how it legally works. And then, okay, now I've satisfied my 1031 exchange. I have this real estate, but maybe it's this, say it's an apartment complex that you 1031 exchange into this TIC ownership. Eventually, I say eventually because it needs to stay in the TIC ownership for a little while. And that piece is hotly debated often as far as like how long it should be in the TIC structure. A more conservative figure would be to keep it in the TIC structure for like up to a year. But at that point in time, these 50 people own this tenancy in common interest in the piece of real estate. They can then contribute the asset into the partnership that is part of the REIT. That contribution is referred to as a 721 exchange. It basically just says that if you own assets and you give it to the partnership, then there's no recognition, there's no taxable event there. So you're not experiencing depreciation, recapture, and you're not experiencing like a capital gain recognition either. So a little bit more painstaking of a process there administratively, because you've got to go through that few extra steps of doing your 1031 exchange into a TIC. Once everybody contributes the property into the REIT, then they're all going to receive at that point in time, they're going to receive those partnership units. So little bit more to it there as far as getting it into the REIT. Now
we've seen a similar sort of structure with probably the more popular end of the DST world now is a similar process with DSTs into the UPREIT type structure as well. And then there's sort of a, again, hotly debated sort of hold period as well. You're saying 2 years there as a typical hold period.
Yeah, 1 to 2 is the safer kind of range there. I've seen some groups say 30 days. I think that's a little aggressive.
But there's no guidance, right? It's a gray area.
Right. And I'll just I'll throw on my speculation cap for a minute here. I'm like, why do they do these things? Why does IRS do the things that they do? And my inclination on this is always they're leaving themselves a little bit of wiggle room to have a gotcha sort of moment there. There is a concept in taxation, it's referred to as a step transaction doctrine. And it's very broadly applied when the IRS wants to use it on like a lot, I think even things outside of real estate. But the underlying principle with the step transaction doctrine is that if there's a process to get you from, A to B, but I'll say, step 1 to step 4, and you could just do it directly. You could just go directly. You could skip steps 2 and 3, and it wouldn't make any difference. Then in that scenario, even if you took steps 2 and 3, IRS could say, no, step transaction doctrine applies. We're going to ignore the fact that you took steps 2 and 3. You just went from step 1 to 4, forget all the other stuff in between. So that's why like something like a 30-day TIC structure could be hotly contested, because they're saying like, you didn't really do anything. You didn't actually have this TIC structure in place to satisfy the 1031 exchange. You just kind of had it on paper for a few days, and then you got to your end result of getting it into the partnership. So that's why you want to be careful in that regard. So, and I would say that's where you have like that extra complexity with the UPREIT transaction. I mean, in my experience, typically they're going to want a higher minimum as far as dollar amount that's going to go into those, because there's a lot of added complexity there, a lot of administrative, compliance costs and things that are going to go into that to be able to have that done correctly. So where I would say like the big advantage that the DST has is that it's more direct. You don't have to go through this whole 1031 and then a 721, and I'm in this weird ownership structure with the TIC thing, and I don't like that because I want to get into the REIT or whatnot. With the DST, interesting thing with it is like for the most part, the DST operates for all intents and purposes like a very, very large limited partnership. However, it still qualifies as real estate because back in 2004, the IRS issued a revenue ruling that was effectively blessing the DST by saying like, okay, it's a very unique type of structure. There are a lot of other, nitpicky restrictions on like how it has to be organized and how it has to be ran. But IRS said this is treated as real estate. So it satisfies the 1031 exchange need of replacing with real estate when you sell real estate. So why I say like, for all intents and purposes, from the investor standpoint, it's very much like, investing in a limited partnership as far as you being fully hands off. Everything else is delegated to somebody else. But the beauty of that qualifying as real estate is, to your point, Brandon, it doesn't just satisfy the 1031 exchange going in, it can satisfy a 1031 exchange going out. Because if we're considered to be holding real estate, the beauty of that is, okay, when the DST does liquidate, say 10 years into the deal, well, it's real estate. We can do 1031 exchange again. So that could be going into another DST deal, or it could be that, okay, now this time I will jump through the hoops, and I'll do a 1031 into a tick and do an UPREIT transaction as well. Or it could just be, I'll go back and buy my own property or something too. It gives you so much more options.
Absolutely. You preserve that swap till you drop strategy. If you go into a REIT in any form, that's where you lose the ability to exchange in the future. You're kind
They're
of
much
married
less
to
flexible.
that REIT until you sell your units, your shares, or I guess leave them to your state. That's possible too.
Absolutely. Yeah. I would say, it's kind of the question we get on this all the time is like, well, then why? It sounds like DST is more flexible. I like that. Why would I do the REIT at all? And this isn't true 100% of the time. I always have to do a lot of due diligence with the REITs too. But very often the REITs are more considered to be quote unquote evergreen style, where it's like, okay, it's going to operate hopefully in perpetuity for the most part. So if I want to do this, it might be more of a headache on the front end with the extra compliance stuff to be able to do the UPREIT transaction, get into a REIT, but then I'm never going to mess with it again. I'm just going to hang on to my REIT shares and take my dividends and things like that, throughout the years, and hopefully not have to deal with like another transaction. Whereas with your DST, they are going to have like a planned liquidation, time period, or it's one of the many restrictions that are imposed there. At some point, you're going to have another transaction you'll be looking at. But I would say, you just have to kind of weigh that for like, do I want to set it and forget it and never have to worry about it ever again? Or do I want to potentially have like those more exit strategy options that the DST is going to give me?
We had a curious tax question around the REIT. Most REITs offer some level of quarterly liquidity, obviously restricted at some point, but offer it. This is very appealing to a lot of our clients and prospective clients. Can you talk about what is the tax treatment when I do that? Let's say I go to do maybe a partial redemption. How is that treated? There seems to be some debate maybe about how much of that could be potentially tax free in a distribution, and when tax kicks in. What say you, sir? How does this work?
Yeah. So that is an interesting, advantage to the REIT. I will say, so the first thing when you're dealing with redemptions is we do want to, the thing I always recommend to my clients is it's very illiquid. So, you want to plan for that. It's not super easy for you to tap into those funds outside of like like quarterly distributions and things like that. But, every REIT I've ever seen will have some kind of redemption policy, and they can be extremely customized, and they often are. But it a lot of times will have annual maximums, for example, on how much it's going to allow just any and all shareholders to actually request it. And a redemption being like, I guess we should mention is you go into the REIT and saying like, hey, will you give me cash and I'll give up some of my shares effectively. So it's like the REIT is that's why we say is redeeming them. Is this kind of buying your shares back. So it's often going to be up to their discretion as far as whether or not to grant it. Some of them will have, a waiting period too, where you have to request it, and it could be up to 90 days, 120 days before the actual redemption is processed. So that's just something to keep in mind. It's not something where you can just call them up and say, hey, I'd like to redeem 50,000 shares. Can you send me some cash? And not that, you hope that there's not any kind of like liquidity issues there too, but they may have liquidity requirements. I've seen that in their agreements occasionally as well, that there's got to be, ample operating funds, of course, because that's there to protect all the shareholders really. But so relatively liquid, first major thing to consider. But then, okay, if I actually get approved and they say, yes, we'll send you that 50,000 you requested, at that point in time, you are going to have potentially a recognition events because that you're ending that deferral that we keep talking about, the 1031 exchange, is that we talked about boot earlier. That's pulling some funds out of the 1031 exchange. This is kind of like doing it on the back end where I've deferred. Now it's inside the REIT, but I'm actually, it's like selling a portion of the property. You can almost kind of think about it as like if I could sell 10% of my house, of my rental property, and keep the other 90 or something like that. Now it'll largely depend on everything else that you have. Again, if you have some other losses from real estate or something like that, it might be another situation where you could do a redemption and have it be tax free. Just kind of depends on the global picture of the client, but most of the time you're going to have a income recognition event there.
You spend a lot of time debunking these myths a bit when prospects come our way and want to talk about REITs. They seem to think the liquidity feature is automatic and guaranteed, which it clearly is not, right? Especially in the worst of times. And they're very confused about what the tax situations will look like. So these are big watch outs. So you're hearing it from Justin, CPA side, like there are bigger things to consider here. And if you're not considering them, you don't have the full picture, the way to think about it.
Right. Yeah. And another big variable is just all things being conducted inside of the REIT as well, because, like I said, usually they're operating in perpetuity, which means they're typically acquiring more assets on a semi-regular basis. So that's where you can have internally, the REIT could be generating tax losses by doing something like cost segregation studies on the new acquisitions that are coming into the fold too. So that's where you can have a lot of complexity that comes through as far as like what you actually see on your documents that are coming from the REIT.
Awesome. This has been great. I think we could keep going for another couple hours, but I'm going to be mindful of your time and our listeners' time. Justin, thank you so much for joining us. This has been great. I think there's a round 2 in here. We get complex questions from our clients every day about their tax situations. And I think this would be a fun forum to kind of talk about once we get 1, 2, 3, 4 of those. It'd be fun for us to walk through a list of those and just knock those out periodically. I think that'd be a fun way to follow up.
Yeah, I'd love to. That sounds just some some of the usual inquiries that you get on a regular basis. That'd be interesting. So
what's the best way for people to find you and connect with you? If they want to talk to you, if they want to replace their CPA, what's the best way for them to reach out to you?
Yeah, great question. So the best way to get into contact with us is you can go to therealestatecpa.com and fill out our become a client web form, and one of our members of our onboarding team will talk to you just to see if we're a good fit, if we're what you're looking for, kind of explain the different service line options and things like that. We like I said, we focus a lot on the planning side, because we know that that's where we can really get ahead of things and save you really large amounts of taxes. But we in addition to that, we do the typical compliance, so you're preparing tax returns. Again, these types of transactions are extremely complicated, not just on the planning side, but on the reporting side as well. So you definitely want to have a tax preparer that's very familiar with some more of these like more obscure types of strategies. Make sure it's getting reported correctly on your tax return. You don't want to jump through all the hoops mechanically and then have it be reported incorrectly. That's always a heartbreak when that is done improperly or whatnot. And then we also have like accounting and outsourced CFO type services as well. So, but yeah, that's a good way to find us. We do a taxes and real estate specific podcast as well. So we put a lot of content out there for free. Like our biggest thing is just educating real estate investors out there on what their options are and whatnot. So you can find that on all the major platforms, but it's the Tax Smart Real Estate Investor Podcast, and we put a new chunk of content out on a weekly basis nowadays.
Awesome. So no shortage of ways to find you, no shortage of content for folks to explore. Yeah. That's perfect. Justin, thank you again so much for coming on. We really appreciate it.
Yeah, thanks for having me.
And thank you all for listening. Until next time, take care.
Take care. Bye-bye.